Over the years, digital assets have displayed extreme volatility. However, the current whiplash in cryptos is driven more by bets on the changing economic landscape than the asset class itself. We decode that and more in the next report. Take a look.
Starting with the record longest US government shutdown, the seesaw in global markets has shown a clear trend: uncertainty. No asset class has been immune to the wild moves, with traders divided on almost every aspect of key drivers in markets. While the divergence in crypto returns compared to traditional assets from a year ago is clear, the traditional levels themselves are a trend story. The wider adoption of cryptos is a reality. Crypto products have expanded exponentially, even as naysayers' warnings continue to reverberate across the world. Investor confidence in crypto seems to be at play, despite the flash crash since early October after Bitcoin's new peak above $126,000, which was called a wild fantasy bet not too long ago. Still, over the years, cryptos have been volatile in general. They have been subject to sudden and massive price swings within a short time frame. Although Bitcoin's volatility has been steadily decreasing as the market has developed, it has been quite high compared to other assets. There have been periods of sharp price drops and periods of very large price hikes. But the current volatility in cryptos is driven largely by wild swings in Federal Reserve rate path bets. The historic swing in Fed rate cut bets over the past month is almost unprecedented. Usually, the Fed would want to have its signal for the next moves to global markets clear and stable, but bets on a Fed rate cut in December have whiplashed violently. Before the rate cut last month, the December meeting was a live event, with over 80% chance for a 25 basis point easing. That changed almost immediately after Fed boss Jerome Powell countered those bets. At the press conference after the October Fed meeting, he said a rate cut next month is not a foregone conclusion. He also emphasized on the deep divide within the FOMC and waved off the intense political pressure from the White House to cut rates. When the US administration goes after the Fed's independence, markets are bound to react. The biggest hit from that was on cryptos. Despite a friendly White House and favorable policies, investors had bet that the next leg up in cryptos would come from Fed rate cuts, with low interest rates feeding into bigger investments into digital assets for better returns. The lack of data due to the shutdown and Powell's comment that the Fed is driving in the fog wasn't lost on markets. Those combined factors led to unprecedented whiplash in Fed rate path bets. In just a month, Fed rate cut bets went from over 90% to a low of 30% and back up again over 75%. That is completely the opposite of what the Fed wants. But a deep divide among policymakers is driving those wild moves. So the crash and pullback in crypto since October is anything but a mere reflection of the uncertainty, rather than a confidence change in the asset class itself. Bureau Report WION World is One.